You are listening to Keystone's Stock Talk Show, episode 212.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again this week. We got a busy show. I will kick it off with a look at consumer spending in the U.S. economy, how it affects the general economy, and what some of the bellwether consumer stocks which report this week are telling us about the spending habits looking into next quarter. In our Your Stock Our Take segment, Aaron will answer a viewer question on Zoom Video Communications Inc., symbol ZM on the NASDAQ, the pandemic darling, which offers a unified communications platform. It reported earnings last week that appeared to be disappointing, but did mention an investment in AI. So Aaron lets you know if there's an opportunity here on the drop. Brennan answers a viewer question on Converge Technology Solutions, CTS, on the TSX Venture, a software-enabled IT and cloud solution value-added reseller, which we have reviewed and warned against on the show in the past, yet keep receiving questions on it. Brennan lets you know his thoughts after the recent price drop. Is it finally an opportunity, as most Canadian brokerages seem to think, or is the stock one to continue to avoid? And last but not least, Brett reviews the topic du jour, the U.S. debt ceiling, which is once again being debated in the U.S. Congress as part of Biden's 2024 budget. Brett will let you know what is going on and if it will affect the markets. So let's get to the show. I'll welcome Aaron and my co-hosts here, Brennan and Brett, the Killer Bees. How are you guys doing? How was your long weekend?
Was
it long enough?
No, it's never long enough.
Never.
No.
Yeah. Did you get up to anything, Aaron?
The podcast.
Yeah.
I missed doing the podcast on Monday.
So you had to come back early, right? Yeah. Or late, one of the two.
Ruined my family's plans, yeah.
Yeah. Did you get up to anything, you two?
I went golfing. Yeah, it was
golfing.
The first. Yeah, it was. I mean,
you said 3 birdies in a row.
Yeah, right beside my house. Yes, it was the first time I ever strung together 3 birdies in a row ever.
Yeah.
The lessons
on a mini golf course.
Not a mini golf course, but I mean, it is a pretty easy golf course, I will admit. So
on a pitch and putt?
No, not a pitch and putt, but pretty small course. It was on a par 3 and then two back-to-back par 5. So I mean, they were pretty short. So. Pretty scorable holes.
Nice.
Anyways, it was a little smoky in Saskatoon though, and as I was saying, I think it's the forest fires from Alberta still. I'm assuming, but right. I don't know for sure. Other than that, Ryan was bugging me last week about was it not hanging out with my Mother's Day or not going back to Prince Albert to hang out with my mom on Mother's Day?
Yes, you're an awful child,
Ryan. And
yes, yeah. Well. They were my parents were in town this weekend, and it was a lot of fun hanging out with them. And my niece is finally starting.
So what you're saying is they had to come to you?
Yes, they had to come to me
to see you.
They delivered some groceries.
We'll just make a note of that here. We'll make a note of that.
They didn't make me pay for those groceries that they delivered as well. Anyways, enough about me. Did you get up to anything, Brett?
Yeah, no, I had my brothers over for a nice steak dinner as our belated Mother's Days. Yeah, I know. I told Aaron nothing about my life. I've been trying to keep this secret, and it finally came out. I actually have 2 brothers and a sister, and that's news to Aaron, but not them apparently.
Yeah. We knew.
Yeah, they knew.
Aaron knew. He just forgot.
I just don't pay attention when people talk.
Yeah, that's true.
Right?
I've got 6 sisters.
Aaron, did you?
I said I've got 6 sisters.
I have 4, but Aaron knows that. I think he knows that by now. Count. He's met most of them, so he should know by now. What? Those are your sisters? What the hell? So did you get up to anything interesting, Aaron?
Nothing really interesting.
No.
We went up to Whistler for the weekend and had some nice meals.
Well, that's like more interesting than us.
For me. It's not my birthday yet, but it's coming up here. So
he gets a birthday week, remember?
Yes. Yeah. Ryan tried to schedule a meeting on my birthday week, and I'm like,
yeah, it was a 10-minute meeting, and that was Aaron's birthday week, and
it's 48. That's a big year, right? That's
yeah. True.
What about you, Ryan?
I already had it.
Did you do anything cool? What about you? You said there was something.
I said I went to Costco, and that's going to segue into what I'm talking about here today. Yeah, consumer spending, right? I'm going to try to share my screen. It was thrilling. Costco was busy as hell, like as it always is. The parking was hideous, and that's why I always go on a Sunday at noon. No, I actually go Sunday at noon, which is like the worst time to go, but it's the best time for samples. And my daughter loves the samples, so it gives us like 2 hours that we get to hang out. The Costco trip would, in a normal time, probably take an hour, and it takes 2 or 3 hours because it's that jammed, and because we wait in sample lines, but it's good times. What is consumer spending? That's a good place to start always when you're talking about consumer spending. Well, consumer spending is the total money spent on final goods and services by individuals and households for personal use and enjoyment in an economy. But why is it so important? Well, number one, it directly affects a country's GDP. In fact, if we look here, this is the U.S. 10-year chart on U.S. personal consumption expenditure as a percentage of GDP, which is gross domestic product. That is the market value of all the final goods and services produced and sold in a specific time period by a country. As we can see here in this chart, in reference to the U.S., consumer spending is currently 68.41% of total GDP. That's about the average in the range of just maybe slightly above over the last 10 years. And that is a very significant part of the economy as a whole. It can certainly serve as an indicator of the general economic health of a country. Now, the consumption of final goods is the ultimate motivation for and the result of an economic activity. This is because companies produce all the goods that individuals consume. It also shows the overall consumer confidence in an economy. Consumer confidence measures how optimistic consumers or customers are regarding their financial situation and that of the economy. This means that high consumer confidence can lead to higher level of spending. So let's look at consumer spending as an investment indicator. Real GDP, which is an inflation-adjusted measure that reflects the value of all goods and services produced by an economy in a given year, often is considered a key economic indicator to watch. If consumers spend less, they provide fewer revenues for a given business or within a given industry. Companies must adjust by reducing costs, wages, or innovating and introducing newer or better products and services. Companies that do this most effectively earn higher profits. If they're publicly traded, they tend to experience better stock market performance. For companies that do not or cannot, the opposite is also true. So let's quickly look at bellwether companies for an indication of where the economy is at present and where it may be headed. A couple report this week. The first is BJ's, and the second would be Costco. BJ's is far smaller, but it does give a good broader economic outlook on the U.S. economy. Thursday, Costco will report Thursday afternoon. We'll take a look at those numbers from Costco next week. BJ's Wholesale Club Holdings, Inc. Let's review what they talked about in their conference call, which was this morning. On BJ's, they reported first quarter results on Tuesday morning that were a bit shy of their earnings estimates. Earnings actually matched estimates, but the consumer or this comparable, same-store sales were shy of estimates. They were supposed to come in around 5.7% for the first quarter. They came in at 5.9%. So didn't miss by much, but did have a miss there. But it was the commentary from BJ's leadership that offered something of a bigger picture for investors trying to make sense of the consumer in the U.S. economy right now and overall. Management continued to suggest that the consumer is growing more cautious while the primary factor driving that caution is inflation. Here are some quotes during their prepared remarks from the earnings call. Their CFO, Laura Felice, said that the company is dealing with an increasingly discerning consumer environment. The CEO, Bob Eddy, referenced the theme of trading down, which dominated big box earnings last week. He stated, everybody wants to save money. Everybody feels like it's a bumpy economy out there right now. Finally, the CFO went on to say, as we sit here today, we see a consumer that is continuing to visit and spend in our stores. On the margin, while they are spending more with us, they are also being more choosy with the dollars and allocating those dollars in favor of necessities. Like I said, I was at Costco this past weekend. I'll say anecdotally, I saw the price of chicken breasts. These are organic chicken breasts. A package was $50. But the non-organic was $30. And I found myself thinking, do I really love my family that much? And what the hell is organic chicken anyways? Is anybody even checking to see whether the birds are what they're really eating? $20 can make a big difference every week. And the thought of trading down in this respect entered my head. Consumer spending is a huge part of the overall economy. And if the consumer pulls back spending, there will be repercussions for economic growth. We keep hearing of a recession, but we're still waiting for it. But there are more signs of a slowdown. And again, you're hearing it this week from the management of BJ's Wholesale Club, and you may hear it from Costco. We'll review that next week.
Yeah, like I was reading an article the other day, basically kind of highlighting the same thing that, Walmart is potentially a top pick right now because consumers are reevaluating their spending, and generally, Walmart does have lower price.
That's goods. From the playbook of necessities, and Walmart offers, lower price necessities. You hear that all the time when you're potentially entering a recession, which may or may not ever happen.
Totally.
But I mean, have you experienced any time where you guys are like, I might buy this, but I'm going to look for the lower version, like trading down? That does affect. So it may affect your more premium luxury goods as we see going forward, and companies that are exposed to that may see weaker results going forward. Aaron, have you had any cases where you're like, I'm not going to buy this and I'm going to substitute for, not going to buy Y, I'm going to substitute for X? You don't care.
Yeah, well, here's the thing is that my wife does most of the shopping, and she's very price sensitive. Like she's like, her thing is that she's always trying to find like the good deal.
Regardless of the economy. That's what you should be doing.
In any economy, right? Like, I mean, she has a huge shoe collection, but in her, to basically give her some credit there, she's able to find like pinpoint really good deals on them, right? So yeah, I mean, I would say
that's what she tells you, right?
I mean, I think that there's obviously like there are some people in society that, they have enough money that a change in the economy isn't going to affect their spending that much. And then there's some people at the lower end of the economic ladder that they weren't really buying a lot of those luxury goods anyways. But it's the people in like that middle class where it's when the economy is doing really well
on the margin,
you can afford to treat yourself a little bit. And, now that the economy, now that there's more uncertainty, I'm surprised we haven't seen it more. Yeah. You would think if this continues, you're going to see more people tightening their belt strap. I mean, Brennan showed that breakdown of the mortgage market, how mortgages are expanding out. So we're seeing how people are affording, like why we haven't gone in.
That's allowing people to continue behavior they should not be continuing. That's an issue.
Basically, it's rather than, okay, interest rates are higher, now we have to tighten our belt straps. It's like, well, we'll just extend the amortization out significantly to reduce, but that only works for a period of time.
And that pain is lagged too. Like there was actually a BNN Bloomberg article that was posted last week, and my friend sent it to me and was like, hey, look, we're ahead of the curve on these amortizations getting extended. Either way, there was comments made by the Bank of Canada, and they said, and I'm quoting from this article, about 1/3 of mortgages have seen an increase in payments compared with February of 2022 before the bank started its tightening campaign that has boosted rates by 425 basis points. By the end of 2026, nearly all mortgage holders will have seen their payments increase, the central bank said. If mortgage rates evolve in line with current market expectations, the median payment increase over the 2023 to 2026 period will be about 20%. So, I mean, we are seeing that lag, and it's slowly going to hit the economy. Also, in this article, it was also talking about just that the average individual that is buying a home between 2020 and I believe 2021 has much more credit card debt now, and is resulting or having to go towards credit card debt, where anyone who bought a new home between 2018 and 2019, again, I'm paraphrasing here, didn't have as much credit card debt essentially. So we are seeing, this is slowly lagged. I'm not doom and gloom or anything. The economy might just continue to clip along. But Canadians and people are starting to feel the pain somewhat by rising costs and rising interest rates.
Yeah, sometimes it takes a while, but
yeah, it should be unavoidable at this point. They're trying to have people avoid it by extending, but like Aaron said, at some point you have to pay the piper, and we should see that at some point. We got to make sure we're adjusted in our portfolios to deal with that over the long term. Good businesses, quality management teams, good cash flow, good balance sheets. All right, let's move on. Zoom Video Communications. Aaron's going to answer your stock, our take on that. ZM on the NASDAQ.
Yeah, certainly a company that does not need an introduction. It was one of the most highly touted companies during the early stage of the pandemic, and for good reason as well. So we're going to take a look at the company. Zoom just released its Q1 fiscal 2024 financial results. So let's just take a walk through here. Company's trading right now at about $66 per share. It's a $19 billion market cap, which for the US really barely qualifies it as a large cap. And of course, not that anybody needs to know what Zoom does, but they are the largest video conferencing platform globally. They serve both the consumer and the enterprise market. So just looking at what the competitive structure looks like in the video conferencing software market worldwide, Zoom has an estimated market share of about 55%. So definitely the leader in the space. Number 2 spot is taken by Microsoft Teams, just under 21%. And it goes down significantly from there. So definitely, I mean, this is a market leader in what I would consider to be, a fairly innovative, growth-oriented market, at least long term. But if we look at Zoom's share price over the last 5 years, it has been an absolute roller coaster for investors. So when the pandemic hit in 2020, all of us are working our communication. Everything went online because we couldn't go outside. And Zoom was there. And Zoom was the number one software platform to fill that need. So the stock price absolutely went parabolic for a while. But then in about October of 2020, so it didn't even get to the end of the year, it started to trend downwards. And it really just hit highs that were absolutely fantastically overvalued, even given all of the benefit that it was providing society at the time. But it has declined from its peak, one of the biggest decliners in the mega cap tech space, down almost 90%, and really no sign since that peak of any type of sustained recovery in the share price. But just recently, the company put out its Q1 results. Now, they did beat analyst consensus. They reported non-GAAP EPS of $1.16, beating consensus by 17 cents. Revenue also beat slightly, but the stock price did drop about 7% after the results as of the time that we did this video. So they somewhat disappointed the market. Obviously, there's a lot of other things going on as well. Financial data coming out or economic data coming out, concerns about interest rates. But this company hasn't really generated any type of a bounce or sustained bounce since the start of the year, as we have seen with many other technology companies. So really a massive drop for what is, a household name and a leader in what should be considered a very attractive space. So we'll take a look at the financials and see what's going on here. Just a snapshot of the company right now. So as I said, trading about $66 per share, and analysts have a 1-year target price of about $85. So a lot of people would look at that and say, almost 30% or so increase. It's pretty attractive. Maybe that's something that we should consider given all of the other things with Zoom, its leadership position. But why don't we just take a moment and just think about how reliable these analyst estimates are? And we're going to do that by going back in time, and we're going to look at what analysts were saying about Zoom back when the share price was close to its highs. So we can go back in time to about April 14th, 2021. This is after the stock had already come down a little bit from its highs, but it was trading about $321 per share. And at that time, analysts had a target price of $476. So big revisions in the analyst estimates here. And, anybody can make a mistake. I'm not trying to say that analysts on Wall Street are going to be perfect. But what this is really trying to show you is that when it comes to pinpointing prices and price targets, you really need to do your own research. Don't look at Zoom analyst consensus and give that really any credit, because obviously they did not know what they were doing. So roughly around the peak, Zoom was trading at a valuation of close to 100 times revenue. Now, we would consider 100 times earnings to be an absolutely obscene valuation for almost any stock. But 100 times revenue it just goes beyond insanity for us. So this is nothing that we, even given all of the utility of it during the pandemic, nothing that we ever could have seen ourselves recommending. It also was not profitable at that time. So really, this was analysts trying to follow a trend and trying to follow something popular, which if you do that long enough, it really just comes down to gambling. And the more you gamble, the more you're eventually going to lose. So we'll take a look at the Q1 results. Fairly lackluster for the most part on an absolute basis, although they did exceed analyst consensus. Revenue up about 3% for the quarter. A non-GAAP operating income up just under 6%, and the non-GAAP EPS up just under 13%. So okay growth in non-GAAP EPS, but still lower than non-GAAP earnings. So you're going to have some taxation or interest obscuring that calculation. But once again, and we've talked about this in the past, when you're looking at technology companies, you have to dig a little bit into those non-GAAP figures, and you have to compare them to the actual GAAP earnings. So that's what we're going to do here. And we can see that when we use the non-adjusted profitability measures, the GAAP operating income, the GAAP earnings per share, it gives a completely different picture. So non-GAAP operating income goes down from 422 million down to 9.7 million. Earnings per share goes from non-GAAP of 116 per share down to 5 cents per share. So really barely profitable in the quarter. And sometimes adjustments are absolutely necessary and they're justified. But whenever there's a substantial difference between the adjusted or non-GAAP figure and the reported accounting figure, you really have to know what's causing that difference. You can't just, a lot of analysts, a lot of investors just look at the non-GAAP and they take that as the accurate number. Many don't, and we think you really just have to look and dig a little bit deeper. So no surprise at all that the major difference between GAAP and non-GAAP is the stock-based compensation. This is a common theme throughout software technology companies. Stock-based compensation, which is paying your employees in stock options or stock rights, is for many of these software companies the largest expense bar none, or very close to. So in this case, 278 million off of about 1.1 billion in revenue. So about 25% of the revenue is just stock-based compensation. And there's a few other things in here: litigation settlements, acquisition related settlements, restructuring expenses. So it's arguable how we should treat those. There's different ways to do it, but you certainly cannot just ignore the GAAP operating earnings, right? So in this case, you're getting a GAAP operating margin of just under 1%, barely profitable. Compare it even to last year when it was much higher, when really the only major expense here in the reconciliation was stock-based compensation, still relatively small margin of 17% compared to the non-GAAP margin of 37% and 38% for this year. So do we completely ignore the non-GAAP earnings? No. But we can't completely ignore the unadjusted earnings as well. A few other takeaways. So enterprise revenue was $632 million, was up 13%, but online revenue, which would be people like myself using Zoom, is down 8% year over year. They did see a 23% increase in the number of customers contributing over $100,000 per year. And they also slightly increased their 2023 financial guidance. So 2024, fiscal 2024. So for the current year, they're expecting about 4.5 billion in revenue. It's basically flat compared to last year, about 2.6% growth. And then non-GAAP EPS is expected to decline about 2%. So net, you're looking at basically flat performance in the current year compared to last year. And that's on a non-GAAP basis. They don't give GAAP guidance. But if you're to just take the non-GAAP earnings, you're looking at a valuation of 15 times, which absolutely for a market leading company like this is not a bad valuation, but there's other considerations as well that factor in. So our take, well, we like the fact that it's a leader in a market, which we think has long-term growth. There's a big bump up in demand during the pandemic. Now they're giving some of that back. Once things normalize out, we do see a continued growth trend for this type of software. A lot of ways that they can develop it, expand it. Obviously, strong brand recognition. They are the leader and a household name. And pretty good valuation relative to at least non-GAAP earnings. Not so relative to GAAP earnings. But on the opposite side, little to no growth anticipated this year. Difficult to know when the company is going to start growing again. Minimal GAAP profitability. And another thing that really kind of concerns me as well is just that I do expect to see a lot of competition from companies that have substantially more resources than Zoom. So even though Zoom is the leader, number 2 is Microsoft Teams. Of course, we've talked before about how Microsoft is one of the only companies that you can invest in ChatGPT through. They are integrating that into their software suite. That includes Teams. So a lot of different things you can do with Teams that are AI integrated. Another competitor a little further down the line is Alphabet or Google Meet. And then there's a few others. But, just looking at Microsoft, looking at Google, I think they want to share this space as well. They are far larger companies with a far deeper technology development teams, lots of cash. So I would expect competition to heat up. And even though Zoom is talking about integrating AI into their system, which I'm sure that they will do more of that, you also have to wonder what is their competitive advantage there relative to these AI behemoths like Microsoft and now Google that is recently released Bard publicly as well. So our thoughts on the company, it's interesting. It's something that we're monitoring, but we're not planning on recommending it right now. If somebody were to take a piece of it, you could, just because it's Zoom, maybe a very small position is a bit of a spec or a gamble, but you certainly, I don't think, looking from the share price momentum on it, there's any hurry. It probably, if I was interested in getting a bigger position in the company, I would just wait for some signs that they were going to start growing again.
So you guys want to give me some guesses here. ARC Innovation, Kathy Wood's fund, about a year ago today, put out their expected value on Zoom, their expected value, their bear case, their bull case. So again, put some context. This would have been after the first 6 months of the year. The bubble had burst in tech, so there was far lower valuations. People were pessimistic. Give me your idea of their expected value, share price target that they thought for Zoom by 2026. And just give me what you think their expected value was. Pardon?
$1,000.
Okay.
600?
And Brennan?
600 maybe?
800.
Okay. Their bear case. What was their bear case?
200.
400.
Yeah, maybe 100.
And their bull case.
Well, that was mine.
Oh, sorry. The 1,000 for me was their bull case.
Yeah. I was thinking the same thing. Yeah, I was going with 800 for the bull.
Their expected is what they reasonably believe it will be at. Their 50% probability, basically. And then their bull and bear were 25 and 25. So if you thought they're expected, what would you think it was then? Let's do that again. Just what they think the reasonable target is by 2026.
600.
600.
Yeah.
600. Okay. And Aaron? Okay, in their bull case.
We already gave the bull case.
Yeah. Okay, fine. We get it. Yeah. All right. Here, I'll give you them. So their expected value was 1,500. Wow. That's their expected value.
None of us want
their bear case. Okay, mind you, it's trading at $65 today, correct? Yeah. So their bear case was 700. Their bull case is 2,000.
Wow.
How do you get that?
Ryan, you forgot the most important part. That's 3 years away. They got time to run.
It's true. It's using a model apparently that they use to value Tesla. So that will work out every time. I mean, Tesla's an absolute unicorn,
and the barriers
right? Like if you look at where it's been,
completely different than, it's.
I mean, you could say they're a leader in their industry, but the competition that they had even at that time from some players with far more capital, good balance sheet with Zoom, but we're talking about growth of 3%, expected growth negative next year, right? I'm not sure how that fund. I don't know how anyone. We're quoting it, but I don't know how anyone does
analysis on it, because once again, ARK were one of the biggest proponents of investing in Zoom, like right at
disruptors.
They thought it was just getting started, basically at the peak, as far as I can remember. Anyways, they were still active buyers of it, according to them. But you were looking at a company with no profitability and trading at close to 100 times revenues, right? So where was were you expecting that profitability to expand into the multiple, or the multiple just to continue to be astronomically high, or were you just throwing valuation analysis out the window?
I think the latter, but to me, you went over non-GAAP margin of 1%, basically nothing, zero. Yep. And maybe you get to 3 to 5% when you take out maybe a couple of those items that are reasonable.
Maybe like acquisition, restructuring, maybe that's justified.
Especially because they don't make acquisitions all the time, at least from my understanding. Maybe
the restructuring, if that was initiative to increase margins down the road, I could see that argument. Stock-based compensation. I mean, like we've talked about it before. There is an active debate on how to treat it, but I would definitely say that you can't just ignore it. Wherever you fall in the spectrum of the debate,
can't ignore.
You just saying, well, we're going to ignore it and pretend that it doesn't exist is not.
So if you pretended it totally didn't exist, maybe you could say it's relatively reasonable, except that there isn't growth. That's the issue right now. And they have to bring growth to the table at some point, even to get, I think it trades at 18 times cash flow, like in that range. And we'd still want to see 10% plus growth to really be interested, and it doesn't have that. So Zoom's interesting. If I think the biggest thing is the competition there. Like you can use Microsoft Teams, you can use Google Meet. There's that would be something that would make me worry going forward on the company, because they integrate perfectly with their software too. So we'll move on from Zoom, continue to watch it, and we'll look at another company that we've also commented on in the past, but we keep getting questions on, Converge Technologies, significantly smaller, CTS on the TSX Venture. Brennan, you've got this one. It's about the third time we've reviewed it now, right?
This is correct. So Converge Technology Solutions, CTS on the TSX, currently trading at a price of about $3.44, a market cap of about $716 million, and a forward dividend yield of about 1.2%. They just initiated a dividend here. So description on the company. So Converge Technology Solutions Corp is a software-enabled IT and cloud solution value-added reseller focused on delivering industry-leading solutions and services. So Converge's global solution approach delivers advanced analytics, application modernization, cloud, cybersecurity, digital infrastructure, and digital workplace offerings to clients across various industries. And the company supports these solutions with advisory, implementation, and managed services across all major IT vendors in the marketplace. So like Ryan said, we have covered Converge a couple times on the podcast. The first time was in October of 2020. You can see on the screen here. And at that time, the stock traded with an enterprise value to EBITDA multiple of 3 times. It had trailing 12-month adjusted EBITDA margins of about 5%, net debt of about $207 million, and a net debt to EBITDA multiple of 5 times, which is pretty high, and shares outstanding of about 122 million. Now, the second time that we covered it was in March of 2022. And at that time, the stock traded with an EV to EBITDA multiple of 22 times, an adjusted EBITDA margin of about 7%. They now moved to a net cash position of about 229 million, and the shares outstanding had almost doubled to 215 million. And both times, my conclusion when I covered the stock was that it had great growth driven by acquisitions. That's top line growth, which was funded by both debt and equity dilution. But the stock had very thin margins. And I noted that several, and I actually got this from Ryan just due to his experience in the industry, that several of Converge's executives were originally from the publicly traded company Pivot Technology Solutions, which was PTG on the TSX, which was in the similar IT solutions industry as Converge. But in the case of Pivot, we saw management rapidly grow the top line of the business through acquisitions with the use of financial leverage. However, the company was unable to establish accretive acquisitions and generate per share cash flow for shareholders over time, which led to a dismal share price. So moving on, just quickly here, I'll show you where their locations are. When I covered them, I do not believe that they were quite in Europe yet. They were just North America, but now they are in Europe as well. And a few company updates here. So in late 2022, November to be exact, the board of directors announced a strategic review process to evaluate a full range of strategic alternatives, including a sale, merger, divestiture, recapitalization, and another strategic transaction, or continuing to operate as a public company. However, on May 9th, just recently, the company concluded the process and indicated that it will continue as a public company and continue to execute on its business plan. Now, like I said at the beginning, recently the board of directors authorized the initiation of a quarterly dividend of 1 cent per share, and they also intend to resume purchases under its NCIB that commenced last summer. Now, in the company's Q1 2023 conference call, management indicated that after acquiring approximately $1.2 billion of gross sales through 10 acquisitions last year, they are pausing to focus on integration, cross-selling, and cash generation. And keep in mind, this isn't net sales, which is actually going to the business. They're referencing gross sales there. So essentially, the company has decided right now to prioritize organic growth over acquisitions in the short term and to continue to gain efficiencies through integration of its past acquisitions, which really we have only really seen the company continue to aggressively acquire in the past. Now, looking at the recent financial results for Q1 of 2023, net revenues were up 37% to $678.2 million. Dollar terms, organic growth was about 6.8% year over year. Adjusted EBITDA increased about 39% to $41.2 million, and that's an adjusted EBITDA margin of about 6%. Adjusted EPS was up 20% to 12 cents per share compared to the same period last year. We will dig into those adjusted numbers pretty soon here. And the company now has net debt of about $321 million and a trailing net debt to EBITDA multiple of 2.1 times. And they are paying variable interest on that debt. And as at the last quarter, their interest rate was 5.1%. And the outstanding balance, I believe, is about 460 million Canadian. And then finally, the stock trades right now with an enterprise value to EBITDA multiple of about 6.7 times. So let's quickly look at how the company is adjusting its net income to get to adjusted net income. Now, you can see that every quarter, the company is adding back significant special charges here. And if we look to see what those special charges consist of, the company provides a definition of special charges consist primarily of restructuring related expenses for employee terminations, lease terminations, restructuring of acquired companies, as well as certain legal fees or provisions related to acquired companies. Now, personally, I think that adding these special charges back may be a little suspect, as the company is consistently making acquisitions and continuing to incur these costs. So, I don't know if we can really take the adjusted figures that they're providing here, but that's just my opinion. I'll get Ryan and Aaron and Brett's opinions after. Now, finally, to conclude here, revenue growth has been tremendous, driven by an aggressive cadence of acquisitions, but in the near term, management plans to slow down on acquisitions and focus on integration. Essentially, we have seen the company go from significant net debt to then issuing shares to improve the balance sheet and get back into a net cash position. But now the company is back into a significant net debt position again, now with debt of about $460 million as at March 31st, 2023, and a net debt to EBITDA multiple of about 2.1 times. And again, it pays interest at a variable rate on this debt. Now, the company trades with an EV to EBITDA multiple just under 7 times, but adjusted EBITDA margins and net profit margins continue to be very thin. And as I indicated, the adjustments that the company is making to get to its adjusted profitability are a little suspect, at least in my opinion. Now, Converge continues to be a company which we monitor, but not a name we would recommend to our clients. And I will open it up to the gentlemen to see if they have any comments.
Yeah, I mean, just generally speaking, software resellers, low margin business. The plan for CTS has been to continue to increase the margin profile over time, the EBITDA margin. We just haven't seen that really play out in real time. And, unless you can see that play out, there is a managed services part of the business. They want to get that part, I believe, to the range of 25% adjusted or EBITDA margin. They think when originally it was they thought at $1 billion of managed services revenue, they could get to that type of margin. I think right now, on an annual basis, they're doing $130 million or something like that, in that range. Don't quote me on that, but I believe that's what I read. They're nowhere near that, and that would help the margin profile overall. But when you're doing in the billions of sales that they're doing now, but it's still a small portion of that revenue is managed services, they just haven't been able to pull up the margin profile of the business, and we need to see them hit on that over time. I've seen brokerage out there continually recommend this stock, continually have a higher margin expectation for the company, and the company just not hit it. And that's why you see the share price continue to go lower in the market. You've flipped from a massive cash position to a significant net debt position. I think the net debt is around $316 million as at the last quarter. Total debt is $447 million. High debt level for a company with this market cap, within an increasing rate environment, in a low margin business, that cuts into your margins, your cash flow margins over time. And it's not something that we are looking at when it's, making it still trades at, on a GAAP basis, a high multiple, despite the tremendous drop in the company's share price. It's just not something that we like. We like a higher margin, better business with, that can actually push more of that growth on the top line to the bottom line.
Exactly. And even if
something to watch here is organic growth going forward as well.
And even if we look at, the GAAP EPS, say in, Q3 of 2022, where it looks like it's, earning 10 cents per share. Realistically, that was primarily from FX, foreign exchange gain, so
not even primarily, just basically,
right? 100%. That's what it was.
Just,
so
no, that's what you're saying.
Yes. Yeah, exactly. So, how can a company like this attract a high multiple if, we're seeing margins like this? And I think Ryan already said that, but.
And the sad thing is, the reason you see so many brokerages, boutique and larger brokerages in Canada continue to recommend this company is because they wet their whistle on a company like this. It keeps doing financings They keep making the brokerages money that way. People that they're selling shares to or selling their research to that are buying this company. It's not the worst company out there. It's certainly, that's not what we're saying, but it hasn't produced the margin improvement story that that the company has promised. And, that's led to a lower share price over time. And there is razor thin margins, and you have now more debt. We just went over this, shrinking profit margins, share price goes down. Not a lot in the kitty to make more acquisitions. I mean, they talked about a strategy of now cross-selling. Well, I'm not sure where the capital is going to come from for them to actually go out there and make acquisitions. I mean, again, there is cash sitting there, but then you just go more and more into debt.
Yeah,
you could raise shares and you dilute more. So
just to give a quick idea about brokerages recommending the stock, they display 13 price targets on their website. Guess how many of them are below the current price of about $3.30, and guess how many are above?
I'd say all are.
They're all above. Yeah.
Yeah, one below. So
wow,
one below. CIBC recommends at a price target of $3, and the rest are $4.50 or higher. Most are about $7. Yeah. So all the major banks, like CIBC, Cormark, they're all recommending it. And this is on Converge's website, of course. This is why it's just
the thing ridiculous. Is, it's been a top pick of I'm not going to name, but of several like boutique brokerages, and it certainly hasn't done well. Again, there are revenues here. There is some level of profitability at times. It's not the worst company that we're talking about out there, but when we see companies that actually have better margins, more consistent growth, these are the type of companies we like to invest in. Yes, this company has implemented a dividend, but there's a massive amount of debt here. Maybe you just want to pay off some of that debt instead of paying back a dividend until it's incredibly sustainable.
And one last point, I actually found what they were targeting here. So this was in one of their past presentations. So long term, the company is aiming to grow its revenue from 2 to 5 billion through 2022 to the end of 2025, and grow its adjusted EBITDA margins to 10% by 2025. So they're looking to grow those margins. Who knows?
That would be probably by onboarding more managed services revenues, which they think they can get the higher margin from, which they likely can. They got to do it. They haven't been able to so far. And, until they can, they're not going to get to those multiples. And even at 10%, it's just okay. Right. It's like, there's many companies we're looking at with 20 plus, percent that are just more interest to us that we'd look at. It's not the worst company out there. We're looking for better companies with better margins over the long term. So finally, we're going to end it off. Brett's going to look at the U.S. Congress debating the U.S. debt ceiling. This is seems to be an annual event now.
Oh yeah, no, it's been something that's been happening more and more these days. It used to actually it's existed for about 105 years, 106 years now. It was done in 1917 initially during World War I was when they initially implemented their debt ceiling, and they transferred from individually issuing loans, and Congress would have to go to that.
I think Aaron remembers that when it originally came in.
Mm-hmm. Aaron was probably watching it.
He was
early on in his career.
Yeah.
All right, though. So the U.S. debt ceiling, it's just once again being debated in U.S. Congress. This time it's part of Biden's 2024 budget. This is almost uniquely an American issue, as the only other country that has a nominal debt limit, so a set dollar value, is Denmark. And the Danes, they normally raise it well in advance of even approaching the limit. Last time they were about 2/3 of their limit when they raised it, and that was the highest it's ever been. So this is uniquely an American issue. And it's not the first time, like Ryan was saying. The debt ceiling has been raised over 90 times historically, but since the great financial crisis, it's been more contentious among policymakers. And frankly, if you don't know, the debt ceiling is simply just how much the U.S. Treasury can have outstanding of their debt. So all your Treasury bills, bonds, and all that, that's how much they're issuing. If the debt ceiling is breached, the U.S. Treasury is unable to issue more debt, and therefore they're unable to pay government bills for Medicare, Social Security, and also unable to roll its existing debt, amongst other things, which would in turn freeze or at least hinder many, many government operations. The U.S. debt ceiling the U.S. debt ceiling is currently about 31.4 trillion. For size comparison, the US GDP is expected for 2023 to be about 23.6 trillion. The equity markets have not reacted to the shifts in the news and opinions of policymakers. Really, day to day, you'll see a bit of an influx. So in a day which you'll see, they're going to pass this bill, which will allow a debt ceiling to be raised. The markets might rally a bit, but then the next day it'll give back. It hasn't been a sustained shift. However, on the fixed income side, we have seen a significant shift. So we saw a significant shift about at the start of May compared to about mid-April of the 1 month T-bills shifting to about 5.5% from about 4.5 to 4.75 in that range, depending on the exact maturity date. And yields have stayed elevated since. So you're seeing about a 75 to 100 basis points uplift just in default risk over the last month. So another way we can look at these events in referring to the default rate is CDSs, or credit default swaps, which is effectively insurance for bonds or a T-bill if it defaults. In the following graph, CDS premiums, so what you're paying, have seen a massive spike to 160 to 100 basis points depending on the day, up from 20 to 40 basis points prior to the debt ceiling being put on center stage. Again, for our listeners, the graph is effectively just a straight up line. And it's, as well, this is an all-time high since 2008. And it is substantially above it. And in 2008, we were seeing the 5-year being higher. Versus this time, we're seeing the 1 year as well as lower maturity, so your 1 month, but this graph doesn't display that. So we can also use those premiums to derive the market's implied probability of defaulting, so the chance that the government will default on an event according to the market prices, which right now is about 3.5% to 4%. So you're seeing Treasury bills having a chance of defaulting in the next year for the 1 years of 3.5% to 4%, compared to the 2011 and 2013 debt crisis. Like Ryan was saying, and I've said, this is not the first time this has happened. 2011, which was the most severe, peaked around 6% chance default. And just for context, the 2011 ceiling was raised 2 days before the expected X date, which is the date when treasuries can no longer issue debt. And the X date does move. It's really a best guess. And it's never really, until it would happen, you wouldn't know the exact time. And in 2013, the government passed the Continuing Appropriations Act to extend the timeline before the debt default and effectively ended the crisis, as they were eventually able to reach a deal. And that was about 4% then, so about where we are now. If you're wondering why the default chance is notably lower than in the 2011, yet the premiums are higher, it's because yields are currently much higher as a result of interest rates, which in turn increases the CDS premiums as the securities trade at greater discounts, which increase the value at risk for the treasury holders. So default risk, it is currently lower than the 2011, but the premium is higher. So really, what does all this mean for investors? I probably lost half of you already running through CDSs and treasuries, but it is a big deal if this does occur. I should really stress that this could be a massive impending crisis if it were to occur. However, if a deal is unable to be reached and the US defaults on its obligations and payments in the real world, we would see significant and far-reaching effects. According to the CEA, the council who advises the president on these matters, immediately following a default, day-to-day operations would shut down, the US credit rating would fall into restricted default, or RD for Fitch ratings, with individual treasuries that do default going into D rating or default rating. In the real economy, the decline of GDP would occur significantly, with immediate expected loss of jobs about 2 million. 2 million jobs lost just by them not passing this. As well, it would likely increase borrowing rates over the long term, as the faith in the U.S. government will be lost. You see a rating decrease from the rating agencies, which potentially weaken the dollar's hegemony worldwide. So your dollarization in other countries would be at risk if this were to occur. But even worse, if we saw an extended default, the stock market would fall by 45% within the first quarter. This is all expected. If this does occur, don't be saying it didn't fall by 45%. This is best estimates by the CEA. And 8 million jobs would be lost. You would see any credit cards, loans, mortgage, interest rates, all that would skyrocket to unprecedented levels. So if you think your mortgage has gone up a lot so far, if this were to happen, this would be peanuts in comparison. the US would fall into a deep recession, as the real economy of the US will be severely weakened. Any credit markets and credit margins are weakened as well. This would devastate not just the US, but most likely the world economy, especially ones that are deeply connected to the US, like Canada. Not exactly a positive note to end on, but I'll open that up to you guys.
I guess we should just say they better get it done, right?
Yeah.
That's what we better say.
Yeah, it really is.
I mean, we would expect, but yeah, it does have dire consequences if it is not, if they don't get that done.
It's one of those, it's one of those times you're hoping it's political theater and not an actual case of them disagreeing, which I'm fingers crossed most time it is.
Yeah, I mean, from when I've observed this for years and years and years now, it is a lot of political theater, people trying to score points, and in the end, if it isn't done, you just went over, you listed a number of things that would occur or could occur if this is not raised, the debt ceiling. That it makes it impossible for them not to at some point. So
exactly.
We would expect, given the stakes, that it will be.
Yeah, this is why. No,
and I gotta say, because Aaron isn't disputing that he recalls when it was passed in 1917. Are you disputing it, Aaron? Your silence incriminates you. So clearly you do remember hearing this pass at that time.
I was going to add to, I was just reading a JP Morgan article here, and they say basically since World War II, the ceiling has been raised or suspended about 102 times, which the last was in 2021. And generally, looking at how the market responds to these debt ceiling episodes, we did see, I guess, the S&P 500. I think this was one of the larger declines. The S&P 500 moved from, I believe, about 1,300 to coming all the way down to about 1,100, right as they were kind of going through this episode. But generally, JP Morgan makes comments here that outside of 2011, realistically, the volatility around the debt ceiling drama is usually short-lived. So usually we see the market recover quite rapidly, but that's as long as they come to some sort of conclusion.
And just in context as well, that was the U.S. actually received a rating downgrade on their securities.
Mm-hmm. That's a great point.
So that was the first time that they happened. They were, I believe, AAA before. Now they're AA, if I remember correctly. I will put it up if I am wrong. So
I believe it was certainly a different and singular moment in time when at that time when it happened. It was the backs of the economic crisis, and but a different time than we would expect them to be able to increase the ceiling this time once again, as we've seen many times in the past. But it is a good discussion point, and it's certainly topical in the markets this week.
Yep.
All right, I think that's going to end our show. Do we have anything else? We're good.
Aaron's silent. He's nothing.
He's gone silent. If anybody who's just listening to the podcast right now and can't see on YouTube, Aaron is just a stick figure basically right now. He's had to run out. There was some unforeseen event that he had to run out to, so we're getting our jabs in at him while he's not there. But we're going to end the show off on that note, jabbing Aaron very hard, and wish that you continue to come and rate and review us on iTunes. And you can also smash that subscribe button if you're viewing this on YouTube right now. Continue to subscribe to our channel. We're getting more and more subscriptions every week, which is awesome to see. As always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.